Okay, I think you should see the presentation already, and also me myself. Right. Okay, so good to go. Hello, thanks for joining me here today. Welcome to my presentation, Introduction to DeFi. My name is Bartek. I'm blockchain developer for over 3 years now, and I'm gonna tell you what the DeFi is. And I'm going to talk you through some examples of DeFi products. And instead of telling you why DeFi is cool, just in general, I'm going to point you out like the exact examples of cool things that you can find here and why it all matters. I'm not going to lie, it's going to be very simple take, even if there are some DeFi experts here, they might find some statements made by me as oversimplifications, but this is, as I say, introduction. So before we actually start, I'm going to do a super short blockchain recap. So blockchain is a peer-to-peer network, as we all know, which is responsible for maintaining a ledger. This ledger is, of course, not centralized as here is shown, but it's distributed amongst all the actors of the network. Everyone has voice, but no one can change the past or influence anything that happened in the past or is already written in the database. It's just a no-go zone. You cannot change anything. And a thing like that is also a base layer of infrastructure for cryptocurrencies like Bitcoin, which works well for a lot of years already. And there are, of course, better things than Bitcoin. For example, Ethereum, which I'm mostly gonna talk about, and what is the basic differentiation between Ethereum and Bitcoin. Of course, there are many, but the main one that we are probably the most excited about is the presence of smart contracts. Smart contracts are like pieces of code that live online on top of the blockchain infrastructure that allow you to program the transactions in a fancy way. So you don't need to worry about some automation level outside of the blockchain space, but you can program various different things directly on the blockchain within the transactions. As you can see here, there is like a super simple smart contract called Splitter, and the Splitter does only one thing. Whenever you send the Ether calling the split function, it will send this Ether to two other users that were predefined, and therefore like introduce some extra complexity to the simple cryptocurrency transactions that we normally have on the blockchains that do not have smart contracts. And these transactions can be as complex as you can imagine, I would say, because they can be almost as complex. There's like almost no limit to that when it comes to your imagination. Of course, there is like some limit to data processing, but it's still like a fair limit to explore. And the key concept of the smart contracts, let's say the most interesting and the most important smart contract type of all that we have is the token. So a token is like a cryptocurrency living on top of the other cryptocurrency. I'm sorry, that's here. And this sort of smart contract is like another cryptocurrency that doesn't have all the nodes, all the mining, all the different kind of stuff that you normally need to run a cryptocurrency, but instead it utilizes the infrastructure of the Ethereum blockchain and runs directly on it, but implements its own logic. It can be like some other just cryptocurrency that does some stuff, or it can be like a token that represents US dollars, other cryptocurrencies that live on other blockchains. Imagination is the only limit. What can a token be? Okay, so after this like short recap and short introduction, what the DeFi is. So the DeFi stands for Decentralized Finance, and basically DeFi is the ecosystem of all different sorts of products, projects, protocols that are implemented on blockchain with smart contracts, and that give people opportunity to use different financial services without any trust, without contact with bank, just directly in the web browser. When I'm going to be talking about DeFi, I'm going to mostly refer to the DeFi that we have on Ethereum blockchain, because it's probably like the most, like personally to me, it's the most interesting one. But the DeFi is not limited to Ethereum blockchain. DeFi can also be on other blockchains. DeFi, the term DeFi can also refer to like the ecosystem of all blockchains and all the projects on top of other blockchains with other cryptocurrencies connected and so on. So this is like a very, let's say, broad term, but I'm gonna stick to Ethereum blockchain and Ethereum ecosystem for now. Right, and I have this like one old screenshot of the DeFi Pulse. DeFi Pulse is the portal that kind of benchmarks all the DeFi, like most used and most popular DeFi protocols, and like measures their total value locked, their traffic, and ranks them in a way. And this is like a screenshot that I had an opportunity to take like 1.5 years ago, and when DeFi on Ethereum blockchain was actually really young. There were like only a couple of projects, and at the time being, there was like $500 million value locked in the DeFi protocol. So it was like more of a sandbox, right? Like a playground for geeks, rather than a real financial market. But today, the very same website tells us that we have over $85 billion locked in DeFi. So it's developing extremely quickly. It's gaining a lot of traction. A lot of people are working on that. A lot of people is using that, and actually it's gaining even like more attention from the media and from generally like all places all over the world. So I would say that the work of blockchain developers, blockchain enthusiasts, and crypto anarchists pays off, and we are getting somewhere, right? This is the place where you want to be. So DeFi is like an ecosystem of all the products, and now why they really matter, like what they can, for example, do, and to kind of imagine like the simplest thing that we can do within a DeFi ecosystem. Let's start with some super simple banking and some super simple example. So what the banking indeed is from the user perspective, like me and you. So bank is a place where you just put your money, like you earn some cash, like not cryptocurrency cash, just regular cash, and put it into the bank. And sometime before, in like a distant past, you were paying bank to do that because the bank was securing your hard-earned money, and you used the service of protection, and you paid for that with your money, and like a little bit of your money. The rest was just secure there. But then it changed a little bit, and banks realized that they can do something with that money. So they do not necessarily need to get paid for that, because they can just use this money to generate some interest, to generate some profit, and then that's like enough value for them. So they just take this cash for free, generate profit, and that's how they make a living. And even the other way around, what we are actually used to and what we expect from our bank to do is that the bank is gonna take our money, generate some simple profit, and actually return us more, share this profit with us. That's what we expect from some saving accounts or things like that. And while banks are today extremely good at this part, they're not necessarily that good at this part. And we can try to fix that with smart contracts, because why not? So let's explore Compound. Compound is smart contract based protocol that basically gives you an interface that allows you to put your now cryptocurrency cash, in this case DAI. DAI is a token, as I said before, so cryptocurrency living on top of other cryptocurrency that represents US dollars in the kind of this ecosystem of Ethereum blockchain. And Compound lets you deposit DAI and then prints you some CDAI, which is another token. This CDAI token basically says, okay, so this guy has some DAI inside of the Compound, and like this, like, you know, some receipt, some ticket that allows you that enables the withdrawal in the future. So this is like simple exchange, and you put your DAI into the Compound pool, and on the other like kind of side of this machine, someone puts a collateral of other cryptocurrency. For like the sake of the example, let it be Ether, the native currency of Ethereum blockchain. And this person that put collateral, oh, I see I have connection problems. I don't know if that still occurs. Okay, that should be better now. Okay, yeah, so the person that puts the collateral can now borrow our funds. Why collateral? Because we need to make sure that the debt that's created is going to be ever repaid. And yeah, basically, let's stick to that explanation for now. We can imagine that in a traditional finance, that would be kind of like a piece of real estate locked in like the banking system. So we can take a loan, complete the purchase, and then when we repay our mortgage, slowly buy the real estate from the hands of the bank. Right. So there is a collateral. There is some person that borrows these funds, and then after some time, the funds are returned with some interest, and this interest goes. I would really like to say that all the interest goes to the lender. Not all, but most of it. Why not all? Because like the Compound protocol needs to accrue some reserve fund in case of emergency. But basically, the drill is that most of the funds, most of the profit, actually go to depositors, to the depositors, to the people that want to earn some interest, and that's an extremely efficient mechanism, as it turns out, because you don't need like thousands of physical places and thousands of workers that are gonna take your deposits and like process this all that stuff manually. This is like extremely automatic and strict secured by the Ethereum infrastructure, and now you only like need a couple of developers that are just gonna create it and then maybe add some new features, but then it's done, it's complete, and it's ready to use. And there are like no these like leaking kind of like leaking pieces of the machine that kind of take your profit and instead of you, yeah, so and it apparently is extremely simple, extremely pure, but extremely effective. And this can even be even more simpler, even simpler, because there's actually no difference between this pool and the collateral part. What I'm talking about. When you add the DAI into the pool, then you get CDAI, right? And then actually on the other end, when somebody puts Ether, also like needs to get some token that will say that there is collateral put in there, and that it will be withdrawable at some point of time. So on the other end, the second person also gets C token, which is C Ether in this case. And apparently, not only this person can borrow our DAI, but we, using our pooled funds, we also, when we pool these funds, we also like gain borrowing power, and we can also borrow stuff that's like gathered in this pool, but not the stuff that we deposit, but the other thing. So we can like put something, gain borrowing power, and borrow whatever else is in the pool and whatever else is interesting for us. Yeah, and now you may ask a question, how it happens that these funds are even withdrawable, because now we can see that this guy, like this girl on the left, has like some C die, 4 C die, but there's like only 1 die inside of the pool because the rest is like lent out. And on the other end, there's like still more C ether than there's ether inside. So how it happens that we are able to withdraw anything? And apparently, like, first thing, there are like lots of people that do this. So whenever somebody wants to withdraw something, there's like a great chance that there are funds for that person available in the pools. So there are like no problems with kind of like exit liquidity of the system. But then there's also this other mechanism, because the situation on the right, we can imagine that if instead of this like 1 depositor, there will be like 4, there's still like more ether than 1/4 of the C ether that was issued in total. So it shouldn't be a problem to withdraw ether, but this DAI, like, it looks pretty dangerous because there's like very small supply of DAI in the pool and very big supply of C DAI, so kind of like a very big supply of demand, like of potential demand for withdrawal. And this is also like a beauty of simplicity of this mechanism, because a system automatically adjusts interest rates, and then if there's like a big demand for an asset and there's like a low supply of this asset in the pool, then then on one hand, the loan taken in DAI in this example becomes extremely expensive. So the borrower needs to pay a lot of interest into the pool. So he's like strongly incentivized to return it back. And on the other hand, if the interest rates are high, then it's a strong incentive for new depositors to deposit in the pool, because then they can make a good buck out of it, because there's like a high demand for their funds. And the other way around, for Ether, right now there's like not that big of a demand for loans in Ether, so the interest rates are probably pretty low, and people don't need to deposit more, because that's just enough. And this loan in Ether is just cheap. And this is also extremely automatic. I'm not sure if I can say that this is extremely automatic. It's just automatic and works well, left alone, and no one needs to interact with it and intervene in any way. And now I want to bring to your attention the fact of the collateral. So why this collateral is actually needed? Because I said that this is because we need to make sure that the funds will be repaid. That's why you need to put some collateral, because the system needs to somehow make sure that you are incentivized to return the loan. And actually, I don't know if that was the exact reasoning and the exact like kind of way of thinking of the creators of the next mechanism that I'm going to describe, but there is a project called Aave, and these guys probably thought something like this: why do we need collateral? To ensure that the funds will be repaid. What is the other way that we can make sure that the funds will be repaid? Well, there is other way. We can because like what's also like 100% sure in the blockchain world, like the fact that transactions are atomic. So you can always take a loan, and if you are gonna return it in the same one transaction, so take a loan and return it back in the one transaction, then you don't need any collateral, right? So you can just take this loan and return it very quickly, and this is gonna be just fine without collateral. Of course, you cannot do this like, performing like a simple transaction. You're gonna need a special smart contract for that. that's gonna do all this stuff. So like take a loan, do something useful, and then return it in the same very transaction. And you can pose a question, very valid one. What is it for? Because like, what's the purpose of taking a loan for the time of one transaction, which is actually like 0 time, because like you take this loan and return it in the same like very moment actually. I can give you an example of usage, and this is something that's extremely interesting in my humble opinion. Let's bring back the compound thing that we had a couple of minutes ago, and then there's this setup when somebody puts collateral. Now let's stick to this differentiation between pool and collateral. Somebody puts collateral, borrows some funds from the pool, but then it's possible that this person that took the loan, just spent it, like bought a Lambo or whatever else, and there's the dice are just gone, and this person is not able to repay the debt. But there's still this collateral, and this person thinks that, okay, maybe there is this debt, but my collateral is worth more than my debt, so I want it out. I want to take this collateral out and repay that debt. And this is like not that simple to do in a let's say straightforward way, because like these funds are locked and there is like a simple statement that's kind of defending them that you need to repay your debt in order to take this out. So what you can do, you can take loan from Aave, like of course with a special smart contract, but there are like probably some utils from that. I'm not sure whether you need to be a developer to do that. There are like products that do that for you. You can take a loan from Aave, repay your debt, then as your debt is repaid, take out your collateral, cut it into like proper pieces, sell this one half for DAI, repay DAI to Aave, and just like keep the rest of the collateral. And all this like needs to be performed in like one single blockchain transaction. So not like we are getting far far away from this like simple concept of transacting like one Bitcoin or something like that, because now this like state transition that happens within one blockchain transaction is like not only like depositing tokens or like calling some function, but now like it's engaging a lot of different protocols, a lot of different products that cooperate and and have some sort of synergy that allow you to achieve like kind of effects that wouldn't be possible without that in place. Yeah. So that's like just the tip of the iceberg. And synths, because like returning back to the previous setup, we talked about like there is Ether, right? We know what Ether is. That's like the most obvious thing here, because it's just the native currency of Ethereum blockchain. And then we have CDAI, C-Ether, which is also kind of like explained, because these are like the tokens that are created when you deposit and they are burned when you withdraw. This is like just this receipt that allows you to operate within the system. But there's like one question: what is actually DAI? Because like this is some token that's worth $1. Why? Who creates it? How does it work? And why is it actually worth $1? What is this DAI? And in order to answer that question, we need to introduce like the idea of synthetic asset, synth. And what a synth is, like the simplest possible synth is wrapped Ether. So you can imagine that there was a problematic thing when the DeFi ecosystem started booming, flourishing, that most of these protocols were created for ERC20 tokens. So ERC20 is a standard of a token, So DAI, for example, CDAI, Ether, Wrapped Bitcoin, many other. And why? Because like most of the assets that live on top of the Ethereum blockchain are ERC20 contracts. So you need to like implement your interface to work with ERC20 contract. With ERC20 standard token. But then still, like putting these tokens aside, the most popular asset on that's I'm not sure if that's true, but that's very possible that, and for sure it's one of the most popular assets on the Ethereum blockchain, which is just Ether, and Ether is not ERC20 contract. So how do we kind of implement all that to work with Ethereum? Of course, we can like duplicate every function in every like in every product, and just like put this like if statement that will kind of distinguish these two different scenarios when you have like ERC20 token and other token, or Ether and token, and like just add like extra complexity to every protocol, which is not that cool because it like makes code far more complex. And instead, apparently, what we can do is we can wrap this Ether, like this native Ether, with like kind of ERC20 interface. So we will create a smart contract that will take a deposit of Ether, and when the deposit is made, then it just gives you the balance of the token equal to the amount of Ether that you just deposited. Or the other way around, if you want your Ether back, like the real Ether, then you can just call a function, say how much wrapped Ether do you want to burn, and then it's gonna be like just removed from the supply, and you will get the real Ether back. And this mechanism, on one hand, like simplifies all the Ether interactions when the Ether is not used as a fuel to pay the transaction as a like an asset to pay for gas, but when it's used as a thing that you want to put in some protocol exchange or whatever else. And on the other hand, it creates like this new thing that's always like that's always worth one Ether, because like this mechanism ensures that this token is like always worth one Ether, because whenever you would buy it for less, then you can always like exchange it for one Ether and you will have profit, or the other way around. It doesn't make any sense to buy it for more, because it won't ever be more than ETH. So this kind of concept. And you can, and like this is like the purest, I'd say, hard-pegged stablecoin, because there are like hard-pegged stables or SIMs and soft-pegged, and this is like an example of hard-pegged one, and probably like it's the hardest pegged one, because it's like ensured by smart contracts that it's gonna work that way. But then you have others. For example, wrapped Bitcoin, USD coin, TrueUSD, and these are like just tokens that have some entity outside of the Ethereum blockchain that says, whenever you send me a Bitcoin, I will give you one WBTC token. Whenever you send me one WBTC token, I will send you one real BTC, or the same with US dollars, for example. And that mechanism kind of help onboard all sorts of different assets onto the Ethereum world, so they can be used in the DeFi ecosystem. But still, it doesn't answer the question what is DAI, because DAI is a completely different animal. It behaves differently. It does different kind of things, and what it does. DAI is the soft-pegged stablecoin. So it's not actually enforced. There's like no programmatic like a very hard programmatic way to enforce the value of DAI, but still value of DAI floats somewhere around $1, and it's like this floating, let's say, limits are very tight, so it's not like, you know, between $0.50 and $2. It's like between 99 cents and $1.01. I would put it like this. And how it works. So the Maker Foundation came up with an idea that you can have some ETH, put it in the vault, and then when this Ether is locked in that vault, you can mint token against that. Like, for example, you have like some amount of ETH locked in this vault, and then you can mint 4 DAIs. And what the system says in this very moment is more or less the statement that there's at least four in that case. There's at least $4 worth of ETH in that vault. So there is like at least that amount of value within that vault. There are, of course, like all different sorts of mechanisms that push this price up or down, depending on the needs. But what's like the most intrinsic value of DAI is the fact that it's backed by at least that amount of ETH that DAI is worth itself, right? So for like four DAI, you would have like probably at least at least $6 of ETH locked in the vaults, and that like gives DAI real value. And you can do with this DAI whatever you want. Like really whatever you want, put it in some DeFi or spend it, sell it, keep it, whatever is your dream about your DAI. And at the end of the day, what you need to do is to repay your debt with like some interest. And now because in Compound, for example, you had to repay your debt in the token that you were borrowing, but here it's impossible, obviously, because you like mint this DAI out of thin air, so you won't be able to repay your debt with DAI because you cannot like you can repay the debt, but you cannot repay the interest with DAI because you cannot just get more DAI. Because it's just, you know, you would need to mint more, and then in order to mint more, you would need to mint more. This is how the fiat money works, but this is not how DAI works. So you need to repay your debt with MKR token, which is like an internal token of the Maker Foundation issued by them. You can buy this token from them and like just put it as the payment, and then we need to think about the scenario, like what would happen if your debt would be bigger than the amount of ETH that's actually in the vault, or what would happen if the amount of like your debt and plus the interest is actually worth more than the value of ETH that's locked inside the vault, right? And actually, this is probably a similar problem to the one that we had in Compound, but we didn't mention that before. So what would happen in such a situation? Because that definitely breaks this equilibrium that we're talking about, breaks this kind of like agreement that there is like at least some value accrued in a contract, and it's bigger than the amount of debt that we are creating. So there is this kind of like a red line that is drawn somewhere between value of ETH that's inside the vault and the amount of DAI that you can mint, which is called collateralization ratio. And this like line here, it's oversimplified, but this is some proportion that says that, for example, you need to have at least 35% more value inside the vault than you have the debt, and if not, then what? If this collateralization ratio is met, then the system says, okay, it's getting dangerous. Your debt is like pretty high. This value of the vault is dropping. We don't want to risk the scenario of ETH going like down even more. and we just cancel your debt. We sell this ETH, we like take this ETH out of the vault, sell it, repay your debt. You can keep your DAI. We don't care. Like the deal is over, right? So the deal is over. Your debt is repaid. We will sell most of your ETH. You will get to keep like this like small amount that's on top. But generally, most of it is sold, and your debt is not. It's not like a problem for you anymore because it's just repaid. And the same situation would happen in case of just you not paying your interest, right? Because then they can say at some point that okay, you are clearly not interested in keeping the agreement, so we just close this vault, take this ETH, sell it, repay your debt, and you can keep your DAI, and you can never repay your interest. It's just done, and the value of DAI holds. But what happens in a scenario of value of ETH dropping so heavily that there is like no time to react, because all that stuff takes time, right? There needs to be a system that says, okay, it's getting dangerous. Now we need to take this ETH out of the vault. We need to sell it on some sort of auction. And then we need to like sell it on some sort of auction to get some DAI from the free market, repay that debt, and like close everything. That takes time. And you need to also remember about the rhythm of life within the blockchain space, which is the mining time of one block. And it's possible that within like these 15 seconds, the price will drop so heavily that we won't be able to maintain this status quo. Or even we don't need like this like a drop this rapid, because we can just have the Ethereum price drop like by half within a couple of hours, and that will be enough, because the network will be so cluttered with all the people doing all sorts of stuff in order to react that we won't be able to like close all these vaults, sell all these ETH. And that would just kind of prevent the system from working properly, just because there's like not enough block space to transact. And that actually happened once. So what at least once. So what will happen in such a situation? The Maker Foundation, which is responsible for maintaining this system, says that if we are not able to maintain and kind of to enforce the rules that that we all agreed on, then we are gonna mint new Maker tokens, and then we're gonna sell them to cover this bad debt that cannot be repaid. And that's actually something that is like an extremely good property of DeFi. Because here, like, this is a problem, right? So when like the price of the currency drops, there is like a complete market crash. It's like nosediving, plummeting. It's just a completely disastrous scenario. Then the kind of like our central bank of DeFi, which I think we can call Maker our central bank of DeFi, is not saying that we are now okay, so now the DAI is gonna be under collateralized, or now we're gonna just take some ETH from other vaults and put it and like from the over collateralized vaults and put it in under collateralized vaults, so everything is even. No, they're not saying that. They're not breaking the promises, and they are not making the losses public. They are taking they're just taking the losses themselves, and they are diluting their own currency to maintain the trust between the let's say foundation, the DAO, and the people that are using it. And there's like we are not like forced to use Maker. So if they were not to and preserve their own values and virtues, then we'll just abandon Maker. In the DeFi world, it's possible. So here we have like this extremely strong mechanism that forces DAOs and these products to behave in a way that people would want them to behave. yeah, and this is not behavior that you would see in the real world, like the world, non-blockchain world. Yeah. So basically, you need to maintain this like collateralization ratio, keep your debt below the collateralization ratio, below the value of the vault, and you're just fine. And what's cool about this mechanism is that you can actually like replace this ETH with anything else. I would say anything else. Of course, the DAO, decentralized organization, that's in charge of the Maker protocol, is not letting any collateral to be put inside the vaults, but there are plenty of them. And if you just want to use the value of your crypto, but you're not eager to sell it, then you can just use that, and that will work well. And hopefully in some future, this is like now not about the present, it's just about the future that I would really love to see. Maybe in some future, you would be able to put a piece of real estate inside the vault and then mint DAI against that. And I think it's closer than you think, and we will see this happening soon. Trademark. Yeah. And now we can ask a question. What can we all use that for, right? Because we can borrow. Basically, that's the like the outcome. Like we had like these two examples, which are more or less like the same. You can like put one cryptocurrency and then borrow. Of course, there was this like depositing and earning interest when it comes to compound, but basically the purpose is just borrowing. So what is it for? And yeah, you can build all sorts of things on top of this like very basic primitive, which is borrowing. For example, you probably know what the leverage is. If not, then I'm gonna tell you. So leverage is kind of a mechanism that allows you to create artificial exposure to an asset. So you actually kind of like borrow the asset to like you borrow something to buy the asset, to like artificially expose yourself to the price changes of that asset more than just spot holding that asset. And that's extremely simple with smart contracts, because what you can do is to, like, of course, now it's overcomplicated a little bit, but I'm gonna simplify this in a moment. So you can like create a vault, put ETH inside of the vault, then mint some DAI, convert the DAI to ETH, create new vault, put that vault create a new vault, put that ETH into the vault, mint new DAI, and so on. And you just create this kind of like stairs like here, and then of course this is like not worth more, because this value is not magically created in any way. It's basically all the same. But when the price changes, then because like let's dig into the details maybe for a second, because like for example you have 200 worth of ETH and $100 debt, and then you have 100 worth of ETH, and like it goes like straight away. But then if the price changes, then the value of your debt is the same, but the value of the ETH that you are holding, instead of like having these DAI, changes, and it can change really heavily. And now, instead of earning, if you weren't to realize your profits, then you didn't earn anything. But on paper, you now earned, instead of $100, almost $200, just because of this structure. Of course, this is like a dangerous, because the opposite way, you can lose more than you would normally lose. But like you are probably aware of that, and you need to be careful with these like sorts of mechanisms. And here I would also like to simplify this a little bit, because like I here created 3 vaults and like made tons of transactions. You can do all that stuff with 1 transaction, thanks to flash loan, right? Because like you can like create like an Excel spreadsheet, or take a piece of paper and calculate how much DAI you would be able to mint in total with all these vaults, how much ETH you get in total, and then like when you have all these calculations, you can just take a flash loan, buy all this ETH, create just 1 vault, mint that DAI, and then use the newly minted DAI to repay the flash loan, and you would have all this like kind of like squashed into like 1 vault, thanks to a flash loan. Yeah, something like that. You can use that to create short, and this is something that's normally very unnatural, because shorting is like profiting from the price going down. And how you can do that? Fairly simple. You can just put your DAI into the pool, take a loan in Ether, so borrow ETH, sell this ETH to DAI, wait for the price of ETH to drop. So now like your debt is worth more, because you need to still repay 1 ETH, which you don't have. So you will need to rebuy it, but now it's worth more. So you rebuy this like 1 ETH for a smaller price. You have some DAI left, and that's just your profit. Obviously, the other way around, if the price of ETH goes up, then oh boy, I wouldn't want to be you in that case. But that's a game for big boys, and you need to always take care. But it's possible, and you can build even more stuff on top of that. Anyway, you can actually use all these mechanisms to actually buy stuff. And maybe that for some people that might be extremely obvious, for other people that might be unexpected, but you can actually, instead of just selling your cryptocurrency, you can just lock this cryptocurrency, take create some debt of DAIs, and then use this DAI debt to fund your life, basically. And then there are like 3 ways of like handling the situation now, because you kind of like live on a loan. So one scenario, you can probably expect the value of ETH to appreciate much faster than your debt is rising, right? Because this DAI debt is not that expensive actually, and it will like rise slowly, and there is like a high probability that the value of ETH will just go up much faster, and you will be able in the future to even like take more debt, because it's you won't ever need to repay it, because of course the value of debt will rise, but the value of collateral will go up even faster. The other scenario is just to repay the debt from your income, right? Because maybe it's not the thing that you want to live off your cryptocurrency, but you just want to take a loan, but you don't like banks. You just don't want to explain what you're doing in your life. You just don't want to like kind of interact with this sort of boomer services, some people would say, bold statement, but some people would say, and you just want to be kind of free. Then it's possible, it's even not like more expensive or more dangerous or anything. You just put your cryptocurrency and then pay this off with your income. And like the final, probably the third scenario is that you can always, use a flash loan to just sell the part of your cryptocurrency portfolio later, when you think that okay, it's time now to sell the portion of ETH and to repay the debt and just be debt free again. And we were we were always like talking about this selling and buying stuff, and that's actually really problematic, because in order to execute these scenarios that we were discussing, we need to, for example, sell something like within one transaction. Like, so we kind of like need to sandwich this process of trade, because we need to, for example, take a flash loan, perform multiple scenarios that we already know that they're possible, but then also trade something, like exchange token for token, and then like repay the flash loan. And that's actually a thing that we didn't introduce yet. How do we trade on the blockchain? And there are like all sorts of options for us. And generally, the kind of the exchange points of tokens that live on top of blockchain are called DEXs, which stands for Decentralized Exchange. And there are, as I say, plenty of them. And and interestingly, some of them are, I would say, skeuomorphic, right? So they kind of try to mimic our, like, the way of thinking about exchanges that we have like off chain, that we have like in a traditional finance. But then we can actually like free ourselves from these like limitations, from this kind of like ideas about how exchange should look like, and we can come up with I see that I have connection problem again. Yeah. So you can like create something new, something pure, and not necessarily think about how it was before, and just create something new. And example of something new that's extremely pure, again, extremely simple and extremely powerful, is the Uniswap exchange. So this is like the exchange that allows you to exchange any tokens, right? Like you give one token, you get another token. And how is it performed? You can think about the Uniswap exchange as about the scales, right? So this is like some weight on one side, some weight on the other side, and then like the ratio between them determines kind of the price. And when you want to execute the trade, you just like have, let's say, one DAI. Here I came up with super simple example of exchange of DAI and USDC. These coins are both worth around like $1. So so we should see the equal amount of these tokens inside the pair. And yeah, so the ratio is 1. There's like equal amount of DAI and equal amount of USDC inside of the pair. And now someone wants to buy some USDC with DAI. So what happens? And this person just puts DAI on top of the pile of DAIs, and then takes like a proportional amount from the other side. This is oversimplified yet, but I'm gonna fix that sometime soon. And now this sort of trade breaks the balance, right? So like changes the balance. Maybe in terms of stablecoins, we can consider it breaking the balance, but if they were like some different coins, like for example Ether and DAI, then maybe it won't be like breaking the balance. It will be just discovering the new price of ETH. But for the time being, let's stick to the breaking the balance idea. So somebody broke the balance, and now the ratio is 1.5 in that particular scenario. So in such a case, someone with 1 USDC can like put 1 USDC and take 1.5 DAI from this other pile, because that was the ratio. And now what was oversimplified? The problem is that this ratio is like not frozen in the moment of like executing the trade. So it doesn't work in a way that, okay, there is this ratio and this is like a fixed price, so I like just put any amount of token and like take any amount of token. No, the ratio changes kind of dynamically within the trade. So the ratio is actually like changed during the time of the trade. So for example, if you are putting a meaningful amount of one cryptocurrency on top of first pile, then you are like making this heavier and you are changing the ratio, and you can like take smaller and smaller amounts from the other side. So here, the person that was kind of breaking the balance paid one DAI to receive slightly less than one USDC, and person on the other side, when the balance was broken a little bit, paid one USDC to get slightly more than one DAI. And this like extremely simple mechanism of scales like drives most of the trade in DeFi and in blockchain. Of course, with different assets, these proportions would be different, right? So you would, for example, have like two ethers on one side and like 8,000 DAIs on the other, and they will be seen as equilibrium by the market, because people will just see that there's like two ethers and 8,000 DAI, and they will just say, okay, that's in balance. That's fair. Yeah, and it's all I'd say that's it for AMMs, because these sort of like exchange design is called AMM, which stands for Automated Market Maker, and it's like extremely powerful. And now it evolves, it changes, but this is like kind of the, let's say, the purest design that we had and that we've seen so far, in my humble opinion. And yeah, now I'm gonna talk about something completely else, something new, the governance, because we are talking about DeFi, so it's definitely Fi, because there's tons of financial stuff. It's maybe decentralized a little bit because it lives on top of blockchain, but still we have like developers. We have these companies that create these products, that create these protocols, and aren't they like the central points of failures? And aren't they like masters of the situation? And aren't they holding too much power? Well, I would use a meme. So, well, yes, but actually no. So some of them indeed hold a lot of power, but they decentralize over time. And some of these organizations achieved a decent level of decentralization already, and they did that with the mechanism of governances. So what is it all about? I'm gonna take an example of Compound. So whenever you use Compound, so for example, like deposit stuff, and then you are not only earning interest. You're not only earning interest in the currency that you deposited, but also you accrue a small amount of comp token. Like there are different ways of distributing like governance tokens of projects, but let's say that's an idea for that. So if you are a user, then you are getting a small amount of comp token. This comp token is just, you know, a token that says this person uses Compound, and this is like it's made by using Compound. It's brought to life by using Compound. You can of course keep this comp token, or you can sell it. You can do like whatever you want, but then like over time you accrue more value in this comp token. And then there are people that accumulate like lots of these tokens, and and they make real decisions. So then somebody with like a voting power of comp tokens can, for example, say that we want to like change some parameter, add new feature, add new type of collateral, do anything. And people that have this comp token can actually vote and decide in a decentralized way. So they're like the protocol, the smart contracts are not governed by the company itself, like the company that just came up with the idea, but the users are actually in charge. Of course, there are like users. This is like one kind of side of the coin. There are like investors. There are like
I'm not sure I understand.
There are different ways of distributing tokens, but generally it's like the concentration of power is not as dangerous as it is in a TradFi kind of world. And yeah, we're going. We are kind of reaching the end, and I'm posing a question: is there more? And the answer is obviously yes. What I here presented you is just like a tip of the iceberg. It's just like the beginning and the introduction. So there are like lots of different things that you can find within the DeFi ecosystem, like starting with NFTs that you're probably already heard of, which are pieces of art that live on top of Ethereum blockchain and can be exchanged, like all the collectibles or artworks or different things. So this is like a culture coming to DeFi, and it's also like bringing real value. There are options and all other more exotic and complicated derivative products. So like I use the simple loan to create leverage, but then using that and other DeFi primitives, you can build really complicated things that are not necessarily always used by like maybe casual users, but also like by traders and like kind of semi-professional or professional investors. Like you can go as complex as you can imagine. There are indexes, so you can create like new tokens that are not like they're not copying the behavior of other tokens, but they are like tokens composed of many other tokens under the hood. So for example, like the example would be a DPI, DeFi Pulse Index, and this index consists of governance tokens of different, like the most, let's say, prominent DeFi protocols. There are insurance funds, so you can buy an insurance that will pay you in case of bug happening in the smart contract. So you can kind of buy some safety in this world. And yeah, this is all like becoming this sort of internet of money. Like people are saying that blockchains are not that useful, and people when like outside of the space, when they ask like, so what is the blockchain for? And then like the most obvious answer is like money. Of course, it's money. Like cryptocurrencies too, but just the regular money also. And then they're saying, yeah, okay, like money, and what else? And this is kind of, in my opinion, it's really they're really like underestimating this power. Maybe Ethereum doesn't like maybe it doesn't like cure cancer or do any other thing that doesn't fix the urgent needs of the world, but there is this thing which Ethereum and blockchains are extremely good at, and that's managing money. That's handling value. That's storing value. That's creating like a sandbox for for startups, for fintechs, for just talented people to create and build all sorts of things that serve the people and not and that are just useful, and that they just bring freedom and help you accumulate value, and maybe will help you help other people in the future. So that would be it. Thank you for your attention. Thank you for hearing me. If you have any questions, then okay, I see there are some. So I think I'm gonna pick them and answer them one by one. If you have any more questions, then don't hesitate to answer. So the first one that I'm gonna answer, what's the ratio between the collateral and the amount borrowed? Is it a fixed percent? So it depends on the protocol. It's generally not fixed percent, as a whole, let's say. But this is in most cases it's a fixed percent for a collateral type. So for example, in Compound, you have some sort of collateral type, and the governance says that, okay, this is a very volatile, and the collateralization ratio needs to be high, and it's gonna be fixed for the time being until the governance changes the mind. But there are different models, and for example, in MakerDAO, you can create 3 types. As far as I remember, I'm not sure at this moment, but I think there are 3 types of ETH vaults. So you can, for example, create ETH with very high collateralization ratio, and it's gonna be the required collateralization ratio is gonna be pretty high, but the debt is gonna be pretty cheap, so you're not gonna pay a lot for that. But then there are more aggressive vaults with smaller collateralization ratios, but then your debt costs more. So for example, you can have okay, so now I'm just guessing. You can check this out at MakerDAO's web app. But for example, you can have a vault with 150% collateralization ratio, and you will pay 3.5% interest annually. But then you can, for example, have a vault with 120% of collateralization ratio, and you will pay I don't know 9% of annually. So they're less and more risky scenarios, and then different interest models. This is not fixed within the DeFi space, definitely. And these are not fixed within the protocols themselves, but they're not changing any minute. These are governance. These are the decisions made by the governance, for example. I hope that answers the question. I'm not very familiar with borrowing in DeFi. Can we get more detailed example with real numbers? So I think I can do that. I'm gonna maybe return to that question in a moment. But actually, this is something that you can probably check. Okay, I think because that would require me entering probably a web app of Aave or Compound, so I can then show the example. I won't come up with an example just from the top of my head. So that in a minute. Can I use DAI for liquidity mining? Another question. Yes, definitely yes. It of course depends. There are multiple ways of earning interest on DAI, but there are several liquidity mining programs that that include DAI as one of the tokens in a pair. So probably I'm not sure if I should like recommend any concrete, but I can say that definitely there are ways to provide liquidity, for example, on on some AMM exchange, on the pair of DAI and other tokens, and then mine some liquidity. The MakerDAO Foundation, MakerDAO, as far as I know, they do not have any liquidity mining programs. There is like the demand for DAI is high enough, but generally yes. Yeah. How would you suggest a financial organization shall adapt to DeFi? Yes, so that's a tough question, and like here I'm gonna be completely honest with you. I'm not a lawyer, and you need to. There are of course, like for example, different jurisdictions, and mine is probably pretty niche. It's not the US. So the things that I'm gonna say are not gonna be that relatable to people somewhere else. This is generally, I think it's not difficult from the technical perspective. It's more complicated from the perspective of regulations, and this is not something that I'm too familiar with. So I don't want to make any bold statements. Maybe I will just add that that I know that there are some sandboxes, that some of the protocols are cooperating with more like institutional customers, and they're like trying to bring DeFi to institutions and to bring institutions to DeFi, but this is not like it won't happen within like a snap of a finger. It's a process and it takes time, and it's mostly the work around the regulations. Yeah, and when it comes returning to the first questions, to the second one. So I think that yeah. So I'm not sure if I have enough time now to like make like live presentation of, for example, Aave. Okay, but I'm gonna share the screen maybe for. Oh, I cannot do that. Yeah, so I can say that, for example, right now on Aave, which is app.aave.com/markets, like the main market of DAI. Right now, the market size is like 884 millions of dollars, of which 700 millions are borrowed. And that makes a deposit APY for the depositors of so depositors earn 12% annually on that, and the borrowers pay 16% of that annually. So that's more or less the thing on DAI. When it comes to other stablecoins like USDC coin, like for example, the market size of USDC is on Aave right now 3 billion. And 2.7 billion are borrowed, so that makes the deposit APY to be 6.7 annually, and the borrow APY 8.1. So this changes. Like from my experience, I can say that the deposit APYs very rarely drop below 5%, and the borrow and the deposit ones and the borrow like are adequate to that. Right now, there is like a lot of movement in. There is like a lot of movement in the cryptocurrency world, so they are higher. But like I've been here through entire bear market of like all these previous years, like 2018 and so, and still like kind of the 5% is like kind of maybe not the floor value, but you rarely see these interest rates drop below that. Yeah, and I recommend like checking out Aave and checking out Compound, checking out some MakerDAO dashboards. Actually, if you want more details and if you're still online, you can ping me on Twitter. You can ping me on Discord. I actually recommend following me on Twitter, and there is the Twitter handle visible on the screen. I'm open to DMs, and yeah, if anyone wants to chat a little more, then I'm eager to do so. Yeah, I'm just gonna check out the chat once more. Maybe there are some questions there. Oh yeah, there was a question about the what stands for W about Raptive. Yes, yeah, definitely that was right. Yeah. Okay then. Okay, I see that there's one new question. I think, what's the better way to get started in the DeFi space for someone coming from CeFi, joining an effort, or trying to build some ideas of own, asking from point of view of ease of technical and regulatory implementations? Yeah, so honestly, I would like at the very beginning, I think that joining somebody's effort is easier if you are asking from the point of view of ease of the process as a whole. Like this is like a very let's say dynamic ecosystem. So I really recommend like joining DeFi projects, DeFi startups, and even DeFi DAO teams. They are like operating very rapidly. They are like really releasing very often. Like the technology is always like cutting edge. So I think like a new person joining the space can learn a lot really fast by joining one of the organizations. Because I think from the regulatory perspective, okay, when it comes to the regulatory perspective, I'm not an expert. When it comes to the technical perspective, I know that it's pretty easy. It's relatively easy to start coding in Solidity. It's relatively easy to like kind of grasp a little bit, so you like feel confident already. But then there are like some, this code is like working with money, so there are like audits, there are like a lot of security things that you need to keep in mind when you are developing such protocols. And I would say I would rather advise at the beginning to join somebody for some even short period of time to learn a little bit, see what are the problems, what are the challenges, what are like the efforts, and then probably start from scratch with something new. And actually, I think that would be. I think that it's not any different from other kind of sectors. Maybe here you just earn this experience slightly faster because everything is operating extremely fast and extremely rapid. Some people love it. For others, that might be too fast, but personally, I love it. Okay. Okay, I think that would be it for questions. I'll wait a minute more. Okay, yeah. So I think I'm gonna be wrapping this up. Seriously, guys, if you have any questions, if you wanna chat, if you wanna talk, then ping me on Twitter, ping me on Discord, ping me on GitHub, ping me wherever else. I always have the same handle, which is Barutko, which just disappeared, but you had plenty of time to see it. Yeah, thank you for today. We're gonna meet sometime in the future because I'm also gonna be helping on a hackathon. So yeah, see you around and have a good one. Bye.